Hello and welcome to another session with RO Academy. In this video, we will look at frequently asked questions on fair value measurements under IFRS 13. Let us dive in. What is the objective of IFRS 13? One of the most frequently asked questions is on the objective of IFRS 13. IFRS 13 aims to increase consistency and comparability in fair value measurements in financial reporting. It does this by providing a single framework for measuring fair value and sets out the disclosures to be made about fair value measurements. The framework defines fair value, the valuation techniques an entity can use, inputs to valuations, the valuation hierarchy, disclosures to make, among others. Does IFRS 13 mandate which assets and liabilities to be measured at fair value? No, IFRS 13 itself does not mandate which assets and liabilities should be measured at fair value. IFRS 13 is applied when another IFRS standard requires or permits fair value measurement. For example, an entity with financial investments carried at fair value as per IFRS 9 will apply IFRS 13 in determining the fair value of such assets. What then is the meaning of fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This definition is based on the exit price notion, reflecting the asset's potential sale value or the cost to settle a liability. It is market-based rather than entity-specific. The value is also based on an orderly transaction, meaning that it is not a price resulting from forced liquidation or a distress sale. What do you consider when determining the fair value of an asset? Fair value measurement is usually for a particular asset. It should therefore consider the characteristics of that particular asset that are similar to those considered by market participants when pricing the asset. Examples of characteristics to consider include the asset location. A building in an urban center will typically attract a higher value compared to a similar building of the same size and condition in a rural area. The condition of the asset. When you compare the value of two identical houses in the same location, one recently renovated with modern appliances, fresh paint, quality floors, and updated air conditioning system, the other in disrepair with aging appliances, peeling paint, uneven floors, and an outdated air conditioning system, the recently renovated one will likely attract a higher value. Which market should an entity refer to when determining the fair value of an asset? When determining fair value measurement, an entity refers to the principal market. This is the market with the greatest volume and activity for that particular asset. In the absence of a principal market, an entity uses the price in the most advantageous market. That is the market that maximizes the amount that would be received to sell the asset. It is good to note that sometimes the principal market is still the most advantageous. Does IFRS 13 define the valuation technique that an entity must use? IFRS 13 does not prescribe a specific valuation technique. Instead, it requires that entities use an appropriate valuation technique when sufficient data is available. The technique selected should aim to maximize the use of relevant, observable inputs and minimize the use of unobservable inputs. The three most widely used valuation techniques are the market approach, the cost approach, and the income approach. To learn more about these valuation techniques, join our in-depth training on fair value measurement at RO Academy. Is an entity required to use only one valuation technique? An entity can apply a single valuation technique or multiple valuation techniques. There are some cases where an entity applies a single valuation technique. For example, an entity uses the market approach when determining the price of a quoted share. In some cases, multiple valuation techniques will be appropriate. For example, when valuing a cash-generating unit, weighting results obtained from multiple techniques is necessary to reach a representative fair value. What is the fair value hierarchy and why is it important? The fair value hierarchy categorizes the inputs used in valuation techniques into three levels. Level 1, quoted prices in active markets for identical assets or liabilities. Level 2, observable inputs other than quoted prices, such as market interest rates. Level 3, unobservable inputs based on assumptions and estimates. It defines inputs that an entity should prioritize, giving highest priority to Level 1 inputs and the lowest priority to Level 3 inputs. This ensures transparency and reliability in fair value measurements, guiding entities in selecting appropriate valuation inputs. How should entities disclose estimation uncertainty in fair value measurements? Entities must disclose significant assumptions and inputs used, especially for Level 3 measurements, and provide sensitivity analysis showing how changes in assumptions could affect fair value. This promotes transparency regarding estimation, uncertainty, and helps users understand the potential variability in measurements. What are the key disclosures required under IFRS 13? IFRS 13 defines all disclosures an entity must make in relation to fair value measurement. The key disclosures include the valuation techniques and inputs used, the level within the fair value hierarchy, any transfers between levels, and sensitivity analysis for Level 3 measurements. These disclosures provide critical insights into the reliability and relevance of fair value measurements, enhancing the financial statement's transparency. Thank you for tuning in to this IFRS session. To learn more about topics such as the application of fair value to liabilities, how to determine the fair value of entities' own equity instruments, how to handle transaction and transport costs in fair value measurement, please register for our IFRS 13 training.